Volatility time bands have a multitude of uses which are covered extensively in Chapter 1 of New Methods in Technical Analysis. I'm just going to go through a couple of examples of how I like to use it. First of all, a little bit about the calculation. What it does is it's primarily an intraday indicator. You can put it on historical charts, but it will lose one of its key elements, and that key element is, instead of tracking momentum on a continuous basis, it tracks momentum based on the time of day that it happens to be. Normally the lowest time frame chart you ever want to put this on is a 15-minute, and this is what I've got here, which is with the DAX, which is the German stock market. And the way the calculation works is to say, what is the range for the time of day that it happens to be on this bar? The default goes back 22 days, take about a month's worth of data. And then when the bar opens, it places symmetrical 1, 2 and 3 standard deviations either side of the opening. This means that the values are always fixed, so as soon as a bar opens you know what the limits of range in theory are for the time of day. Just going to go through one day on the DAX where there is an example of a few different trades that you could do. The market opens over here, starts trending downwards and goes to the limit of range for that time of day. And when that happens, that indicates to me that the trend is pretty strong, and so then what I can do is simply put limit orders above the market, and normally I would do this at 1 deviation up and possibly 2 as well. So instead of selling weakness based on the close, which what most people do because that's what their indicators go through, this is trying to get the counter move against the dominant trend to get really good trade execution. What makes this pretty easy is that if you sell at 1 up, for example, if price closes above 3 up on the same bar, that's your stop. You could just put it a few ticks above 3 up, because if the market is going down, you certainly don't want it to be going above the third standard deviation. The market then continues to go down, and here we have a time continuation divergence signal. And what has also happened is price has hit 1 up and it's an up bar, so that's the first sign that there's a potential reversal happening. If I was short, I could possibly just take my money there or look for opportunities to get long. That opportunity actually comes in the following bar because we hit the limit of range, which is 3 down on the next bar, so I could have had a limit order in there. If I'm being more conservative, I can wait to the next bar, because now we don't hit 1 down and we close above 2 up, so the trend is changing. We sort of meander sideways quite a lot through the rest of the morning, and then towards lunchtime we start breaking up, and you can see that what's happening is we're just hitting maybe just 1 or 2 down on a couple of occasions. So if you're very aggressive, for those who like to do that, this gives you opportunities to pyramid strength. We accelerate into the afternoon, the American market opens, and so if I'm looking for profit taking points, we hit 3 up. So we've already been trending, and that is the limit of range for that time of day. A couple of bars later, I get the opposite time continuation divergence signal. So this will give me the opportunity to say, well, I really should be out of this trade if I hadn't got out before. And if I wish to be aggressive, I can get short, and the price comes down, hits 3 down a couple of bars later, and then we just simply get out at the close of the day. I've now moved on to the Dow Jones on a 15-minute chart. I'm just going to show you a couple of other qualified trades. They're both buy signals, and what they're using is the pop signal, so divergence, and it's qualified here by the fact that it closes above 3 up, so it's going beyond the range that is normal for that time of day. And the market edges up. We hit 3 up a little bit later, so we could have taken some profits. As soon as it's starting to hit 2 down, then you can say, right, fine, I'm going to get out of this trade. And then the following day we had exactly the same signal. So market's pretty choppy early on. We get a divergent signal, it closes above 3 up. And this one was quite hard to hold on to. We could have quite easily possibly got stopped out if it had closed below 3 down. But eventually the market does rally, and again we could look to be getting out on the close.